All righty. Good evening, everyone. Glad to see you all here. Hope you're all having a good week. I want to just go over a few things and then I will turn the room over to Jared. I'm just curious. I'm not going to be able to see everybody. I was just curious how many of you on this call are newbies? This is your first year, maybe wave. Let me go through and see everybody. Oh, not everyone has their camera on. All right. Well, that worked better this morning when I had people stand up. So won't happen tonight. But I just wanted to say again, thank you all so much for joining our family here. We have a great group of volunteers, and I'm really excited as we're starting to get things moving again. So has anyone, I'm sure no one has, but because it's not up and running, I just wanted to let you know, Lincoln Learn, the website that we use for our certification was supposed to be up and running yesterday. It is not. They said they will be sending out an email letting us know when it's ready. I'm on a group of taxpayer or tax. It's a VITA group, and right now they are taking bets as to when Lincoln Learn will be ready. Somebody said the end of November. Hopefully it won't be that long, although most folks probably aren't quite ready yet to take that test, but I will keep you posted as I hear. I'll let you know. Last week, Jared had mentioned Mid-Penn Legal Services and Bob Hamilton. And so I was able to get him to come to our next session on November 30th. He will be here around 6 o'clock. And so he will be sharing with us what Mid-Penn Legal Services are, and how we can make referrals, the type of referrals, that type of thing. Because there may be times when there will be taxpayers who, I would say particularly when they have a large bill to the IRS, and figuring out ways to help them take care of that. So Bob will be here next week. We'll also be doing, the beginning of January, we will be doing some kind of marketing outreach to the community. Last year we had 5 different sites where we all met and then went out into the community and put posters posters of our services. Second here, I need to admit some people. Posters about VITA services. This year we have a little bit of a different marketing strategy, but we will still be wanting to go out and kind of saturate the community and let them all know about our services. So I will be sending out an email about that later, probably in December sometime. What else? Oh, I just confirmed a new site this week. We will be having a site at Manheim Salem United Methodist Church. It'll be one day. I still need to confirm the day. It will more than likely be Tuesday from 11 until 6. So I don't know how many of you are close to that Manheim site. So there is a new one in that area. And then something else that came up this week. So we will work with clients who are refugees, or just are resident aliens, different classifications. But basically, there are folks that are in our community that do not have a social security number or do not have an ITIN. And Jared, what does that stand for again?
So it's basically the ITIN's a individual tax identification number.
Okay.
So not a social security number, but close to it. So it's basically a way the IRS can identify individuals.
Okay, so there is a process for an individual to get that number. It is a bit involved in that the application is pretty easy to complete, but there are some documents that need to be certified, passports, identification cards from the country where they live. And so we're looking for individuals who might be interested in becoming a certified accepted agent. And that person would be able to help individuals fill out the application and then certify all of the documents that are needed for us to send into the IRS. The process is it'll probably take about a year, and we're willing to pay for any costs that might be incurred. And so we are looking for individuals who might be interested in doing that. I'm hoping that it's something that we can do over the summer, but we will be doing it year round once we get folks that are certified. We've been working with more organizations that work with refugees, and so this is definitely a service that they would need. And so we're going to be looking into getting Ed certified, and then anyone else who might be interested. Um, that is all I have for right now. So unless there's any questions, I will turn it over to Jared.
All right, I greatly appreciate that, Kim. We'll go ahead and enter into our presentation here. So let me go ahead and make sure the screens are sharing appropriately, and hopefully we are able to see the slides popping up on your screen. I will go ahead and try and keep an eye out for any questions that might be arising. Again, if you have anything, feel free just to let us know, or send a message in the chat, and we will be sure to pick up any questions you may have through the presentation. Are we looking good, Kim, for audio and video so far? Oh, and sorry, you're still muted, Kim.
Yes, we are good.
Okay, all right. Well, good. If you hear me telling you're muted, I guess it sounds working pretty well. So I guess we're okay to go there. All right, wonderful.
Yeah.
So today is going to be a little bit of an interesting conversation topic. So we've moved beyond the first training session, talking about dependency and talking about our filing status, moving now into our areas of income from our last session. And now at this point, we're going to go ahead and get into our deductions and credits. So tonight's always a fun night when we talk about how we go ahead and we help our clients actually reduce either their taxable income or actually reduce your overall tax liability, hopefully to the extent of a refund. So we're going to go through a couple different areas here tonight. First, I want to start in the area of deductions. So I'm going to talk a little bit about our adjustments to income. So these are the areas that are within scope for VITA program. And I do apologize. I'm coming down with a bit of a sore throat here. So hopefully we'll be able to get through with no problems. But our first area that we want to take a look at are adjustments to income. And our summary list is going to be shown on the E3 of the 4012. So these are the areas that were within inside our scope parameters for VITA. And we're going to talk a little bit of these in more depth, including the educator expenses. I want to kind of mention a couple unique things about educator expenses, as well as our health savings account activity. One thing we do have is a penalty on early withdrawal of a savings account or a certificate of deposit. Fortunately, that one is automatically going to populate if you enter the information off the 1099 INT. So the 1099 INT, again, to report interest income. But there is a box on that form to indicate if there was any of a early withdrawal penalty on those accounts, or any type of accounts that were supposed to have a set time. As long as we enter the information off the 1099 INT accordingly, it'll automatically populate in the correct box and area on the form 1040. We're going to talk a little bit more about alimony paid, also some IRA deduction rules. We don't often see that within VITA, but want to explain a couple things of how those can work, and also a little bit later talk about how we might be able to save some clients money by utilizing an IRA deduction, and also give you a couple pointers on student loan interest deduction. So heading right into our next category, I want to talk a little bit more about the educator expense activity. And educator expenses are allowed on the return. It's what we call an above the line deduction. It's effectively allowing us to offset our taxable income dollar for dollar. These are very, very good benefits. They're actually going to help us reduce taxable income for a taxpayer. So they're good. I'm not going to have any problems with a deduction, but we'll talk about something a little bit better, which are tax credits. But we do want to take advantage of any opportunity we have to help reduce a taxpayer's income or total tax. And one of those is the educator deduction. Now, this has been around for a couple years. The amount of eligible deduction for federal purposes is up to $300 per educator. So if you have married filing jointly return, we can take up to $300 per taxpayer and spouse. So you can actually get up to $600. So, what we're going to take a look at is what we mean by the definition of an eligible educator. So, what we're looking at here in this case is going to be anyone who's a teacher, an instructor, an aide, a principal, a counselor, anyone who works in a school grades K through 12. So, a homeschool individual does not count for the eligible educator deduction. So, that is not allowed under the tax code. You have to be employed for at least 900 hours. So, basically, you're looking at least half the school year for that to qualify. But there are a number of things that can actually meet these definitions. So a couple of things that qualify would be things like our books, any of the supplies, equipment that includes any type of computer equipment, software programs, computer services that might be additional or supplemental material for the classroom, and any other materials used. So that includes things like items you might have if you're going to put a bulletin board together or some sort of other activities inside the classroom. Also includes, uh, we probably should have indicated a little bit better, personal protective equipment, although we had a question a little bit earlier. What does protective equipment mean? It does not mean you need to carry a stun gun into the classroom if you have a bunch of unruly first graders. What we're talking about is protective equipment, essentially still coming out of the COVID environment, whether those may be things like face masks or gloves or shields or using a disinfectant. So, taking care of the classroom, air filters, that type of thing are all eligible expenses for this definition of qualifying expenses. Also included in here are professional development activities. So, if someone's heading off to a conference that is used to help enhance education, that's also eligible for this $300 credit. I do want to make mention of our very last point down here. This is only for out of pocket expenses. So if the individual is getting reimbursed by their school or their employer, they are not eligible for the deduction. So it has to be an actual out of pocket cost. So oftentimes the teacher may go to a conference, particularly over the summer or some other time. If the school pays for it, we are not able to take that again as a deduction. So it has to come from a true out of pocket expense. One thing we're going to learn today is, especially when we talk about taking money away from the government, usually there are a couple caveats and some very unique rules as it applies to our process when we talk about how these rules are in place. So one of the things I'm going to mention here is we have a uh, interesting position. And again, I'd love to go back and determine who exactly had an objection to every educator having an expense. But somewhere along the line, someone in Congress decided we need to have this provision in here because otherwise I'm not going to be very happy. We cannot include expenses for non athletic supplies for courses in health and physical education. And again, we mentioned no homeschool, but I'm not quite sure what happened that one of our people in Congress had a horrible experience within the gym or the health classes that they're not allowing non athletic supplies to be a deduction. So, just as a little warning for those who might have clients teaching health or phys ed, any non athletic supplies are not going to qualify for the educator expenses. But other than that, most of our educators know that they're allowed to go ahead and deduct these amounts. For federal, as I mentioned, it's up to $300 per educator. We do have an ability to take a deduction for PA purposes as well, which we'll talk about in our fourth session. For Pennsylvania, we do not have an upper limit. So we want to ask how much do they actually have. Hopefully, they know their exact amount. They kept records of it, and we can use that full amount for Pennsylvania purposes. Question that always arises is how much do we need to have in documentation? And what we want to be able to do is have a reasonable assurance that the information provided by the client is accurate. So we'll ask them the information. How much do you have? If it seems plausible, we're pretty much all ready to go with that. So, an educator comes in, they said, well, I think I have $417 of expenses. That sounds reasonable. If they come in and they say I have $41,700 of classroom expenses, probably not reasonable. We do want to remind the taxpayers that the substantiation rules mean that the taxpayer has to come up with that documentation if ever audited or questioned by the IRS or other state authority. So the taxpayer is going to be responsible for any of the documentation for any of these deductions, credit, or payment amounts. Okay, switching gears a little bit to our health savings account or HSA plans. So these are an incredible benefit, very, very popular, particularly among people who are eligible for a health savings account. And in order to be eligible, what the individual needs to do here is they have to have a what we call a high deductible health plan. So it's essentially a medical insurance plan that the insurance does not kick in until a higher amount of medical expenses have been incurred for the year. So not designed for someone who might be seeing a physician on a regular basis or someone who thinks they might have substantial health needs throughout the year, but basically designed for someone who may want to pay a smaller monthly premium for their healthcare coverage, but the health insurance won't kick in until much later in the year. And what happens in this case is the government allows what we call a health savings account. So the health savings account will allow the taxpayer to put money aside and actually in a specific savings account that can be used to pay for medical expenses. Now, most individuals, when they take advantage of the health savings account, it's most likely with an employer. So they're going to opt into their health plan, generally happening around this time of year for a calendar year plan. They'll decide what type of plan they want to be in. If they opt for the high deductible plan, they are then eligible to make a contribution to their health savings account. In most cases, those dollars are going to be done pre-tax. So they're going to have the ability to go ahead and have those dollars go in before federal taxes are withheld. And where we see this is actually on the W 2. If you take a look at the codes in box 12, the code W is going to indicate employer contributions. Now, what employer contributions are effectively anything that's either paid by the employer or a pre-tax deduction to the employee's HSA. So those are perfectly fine. We're going to be able to take a look and see how much has been contributed. If that's the case, if all the money has been either contributed by the employer or on a pre-tax basis, the taxpayer does not get any additional deduction. We'll just go ahead and fill in the forms as appropriate. Likewise, the taxpayer may also get a Form 5498 SA, which is going to indicate the amount of contributions made for that current year. So anything, as I mentioned, on a pre-tax basis, that's fine. That's going to be considered a contribution by the employer. Anything that the employee has done, and that's traditionally going to be an after-tax contribution. We don't often see these within VITA, but if you have a health savings account, you may get a reminder to say you're still eligible to contribute a little bit more money by the end of the year. And if the employee does so on an after-tax basis, then we're going to go ahead and make that contribution and report that on the health savings account form, which will not only generate a federal tax deduction, but is also eligible for a Pennsylvania state deduction as well. So we just want to be cautious. If someone says, well, I did put in $1,000 for my HSA, you take a look at their W-2, and in box 12 in code W, you see $1,000. That all went in as a pre-tax contribution. So no additional deduction. We don't want to enter that information in twice. So the reason why these are popular is because you can put a fairly decent size of money into these accounts, and you don't have to use them right away. They can actually follow with you throughout your lifetime. So once you are no longer eligible for health insurance or you're eligible for Medicare, you cannot contribute to an HSA. However, you can always use those funds at some point in time for any of those medical costs, and we'll go through that one on the next slide. But the good news is we have a high amount of an HSA deductible contribution. Again, whether it's done through the employer on a pre-tax basis or whether the taxpayer decides to do this after tax. If you're in a family plan for the entire 12 months, you have a deductible amount of $7,750. For a self-only plan, $3,850. And if you're 55 or older, you get an extra $1,000 added to those amounts. So it's a pretty nice program to take a look at if individuals are eligible. Again, we don't sell insurance within VITA, but we can work with the HSA program to determine how we're going to handle our contributions. So one of the major benefits of the HSA is really on the distribution side, because not only are we getting a tax deduction or an advantage for the funds going in, but when the funds come back out again, they're actually tax-free as long as we are using those for qualified medical expenses. Now, what we're going to see is that the taxpayer is generally going to get a 1099 SA, which is going to stand for a savings account. If you were paying a lot of attention last time we were meeting, we were talking about forms that have a 1, a 0, and 2 9s in it. We need to report that information on the individual's tax return. The government will get a copy of that as well. So we do want to report how much the individual has in distributions from an HSA. But as long as those distributions were used to pay for medical costs for the taxpayer, the spouse, or their dependents, we're going to be fine. There's no tax, no penalty, anything else associated with those. Those can be used for, as I mentioned, any medical copays. It can be used for things like uh, dental, vision, orthodontic, any other type of qualifying medical expenses. If the funds were used for qualifying medical cost, we just want to go ahead and put that exact amount of distribution in as qualified distribution and no tax, no penalty. It's actually fairly difficult to get money out of an HSA uh, for non-medical purposes. In fact, most times you'll actually get an HSA debit card that you can use at a qualified medical practitioner. You can use that to pay for those costs. You cannot use that debit card to go to the local gas station and fill up your tank of gas. So the debit card typically works for medical practitioners. You can request a reimbursement or a check from the HSA, but that's a relatively more lengthy process. So the reason why I mention this, if we have a distribution from an HSA, not for medical purposes, the amount received, the entire amount received is going to be taxable income to the extent it's not used for medical, and will also be subject to a 20% penalty. So last week we talked about the 1099 early withdrawal penalty on the 1099-R. 10% if you take money out of your retirement account before 59 and a half. We thought 10% was pretty bad. 20% is even worse. So hopefully we don't have a situation where someone's taking money out of the HSA not related to medical costs. Now, a couple exceptions are in effect here too, much like we had with the early retirement distribution. So death, disability, or if you reach age 65, you can take the monies out without that 20% penalty. Okay, wanted to move on over to alimony. So we talked a little bit about alimony as an income item in our second session, and the same rules or a mirroring rule is going to apply here for alimony paid. So if the divorce had actually been completed by December 31st, 2018, the individual receiving alimony payments would be reporting those payments as taxable income. The person making the payments would actually get a deduction for those alimony payments made. So the good news is, especially for new volunteers, we don't have to ask about the new divorce situation. So if someone's been divorced after December 31, 2018, the payments are not deductible. The amounts received are not taxable. This is only for divorces that basically have occurred by the time we get to filing season over 5 years ago. So most individuals already know whether or not they were falling in the alimony paid deduction capabilities or if they should be reporting alimony income. So one of the rules that we take a look at here are what the IRS considers alimony. So we have to meet all of the following conditions. So first of all, we need a required payment by a divorce or separation agreement. So it's a legal document that requires a payment from one party to another. And again, don't worry, we don't have you here invited trying to take a look at legal documents and opine on whether or not that you believe it's alimony. These are all going to be for divorces that happened over 5 years ago in the most part. So we're just going to follow and ask some questions here. The next point is I always find fascinating. The government makes sure that the person making the alimony payments and the person receiving the alimony payments are not filing as a married filing joint return. Never really made a lot of sense to me because I'm not quite sure why you're paying alimony to someone you're still married to and still filing a joint return. Plus, mechanically, you would have income reported on the return and a corresponding deduction. It would not make any sense. So that's not alimony. Payment has to be made in cash or cash equivalent, so it could be an actual cash or check payment. It could also be that the individual is paying expenses on behalf of the alimony recipient. It could be things like child care costs. It could be mortgage. It could be other things. Those are all considered alimony payments. For those of you who like and respect the English language, the next one is very bizarre. This category is basically saying the payment isn't designated as not alimony. So we have, in fact, in a 6-word phrase, have a double negative. So what we're basically saying is the agreement cannot state that it's not alimony. I mean, effectively, we're going to say it's either going to be stated as alimony or it's going to look like alimony. As long as we say in the agreement it's we're not saying it's not alimony, then it's most likely going to be treated as such. So again, we're not going to have you do any legal type advice here for VITA. But if a question does pop up on your exam, just want to be sure you understand what the characteristics of alimony would be. So the spouses have to be legally separated or divorced, and they're not going to be in the same household. Uh, they're not going to be living together. The payments are not going to be required after the death of the recipient spouse. So if you're receiving alimony as soon as you pass away, those payments will cease. And also, child support payments will not be considered alimony as well. Those payments are going to be non-taxable to the recipient and not deductible by the payor. So just want to go over a couple quick rules on alimony. Okay, how are we feeling? Any questions popping up in chat? Okay. Looks like none
Jared,
yet.
I'd like
Yeah.
to ask
Oh,
two
yeah.
clarifying questions.
Yep, go ahead, Ed.
You said that if we had any accumulated balance in our HSA account and we reach Medicare age, use the HSA balance for paying Medicare expenses, basically, not Medicare expenses, but non-reimbursed expenses while we have Medicare.
Correct. Right. Yeah. As long as you cannot contribute to the HSA anymore, but the plan is allowed to continue as long as you're either going to go ahead and use those for qualifying medical costs. So you can still take the money out of those. You just cannot contribute once you hit Medicare age.
And the second question was the HSA distributions was on the 8889. What is the 1099 SA?
Oh, sure. So the 1099 SA. So you're actually going to have two different areas here. So the 5498 is going to be showing the amount of contribution to the HSA plan. The 1099 SA is going to show the distributions from the plan. So much like when we talk about retirement accounts, the 5498 is going to show the amount of money that went into the plan for the year. The 1099 is going to show the amount coming out of that account for the year. So the 5498 we may or may not receive. Generally, for most of our clients in VITA, almost all their contributions are going in through the W-2 through their employer with a code W. So we won't really have any additional amounts that would qualify for the deduction. But we do want to keep track of those distributions, and that's where we're going to see that Form 1099 SA. And that's going to show the total amount that they had withdrawn from the account. That also does get reported to the government. So we want to be sure we report those amounts on the return. Did that help out, Ed?
Absolutely.
Okay. Perfect.
And Form 88889 was, I must have wrote that down.
Sure. Yeah. So the 8889. Yep. So the 8889 is where we're actually going to show both our contributions and distribution. So the contribution part, we're probably not going to see a whole lot of additional deductibility items there. So again, most of it's probably going in pre-tax through the employer. But if we did have someone who put something in post-tax, if they did an after-tax contribution, they would actually get a tax deduction for those contributions to the plan, again, up to our limitations. But the distributions are going to be reported effectively on the second part of that 8889. So that form is going to show both the amounts going in and also the amounts coming back out again to determine if there's any taxable amount that we need to be concerned about. So the 8889 is kind of a magical form for both contributions and distributions at the same time. Okay. How are we feeling on the HSA? Any additional questions? Okay. So as I'm kind of talking about these forms that we have, these 5498s and everything else, we sometimes also see those when it comes time for IRA contributions. We historically have not seen many IRA contributions coming through VITA, but they are within scope. They are entirely possible that we can go ahead and have these occur. So a taxpayer may contribute to a traditional IRA and get a tax deduction. We used to have a restriction that if they reached age 70 and a half, they could no longer make a contribution to a regular IRA. That's actually gone away now. But what they do have to have is earned income. So we have to make sure that we have some element of earned income. I'll kind of mention a couple of those same things that we have for earned income credit. But generally, that's our characteristic. If only one spouse has earned income and you're filing jointly, The non-working spouse can actually use the earned income of the working spouse in order to make an IRA contribution. These are pretty nice planning techniques because we can make a IRA contribution for 2023 all the way up to April 15th of 2024. So the nice part is we have the ability to potentially work with the client. If they haven't made a contribution yet, they still have the opportunity to do so. That amount is going to be the lower, again, of their earned income, or $6,500 for 2023. If they are 50 or older, they get another $1,000, so it's going to go up to $7,500. There may be some things we have to take a look at to determine if they're either actively engaged, they're working with an employer who provides a retirement plan. Again, if we take a look at the W-2, right near box 12, there's going to be 3 little check boxes. So if we enter the W-2 exactly as presented, you'll check the box that'll say retirement plan, and that'll go through some calculations. So you just want to take a look at box 13 on the W-2 to make sure if they are a participant in a retirement plan. Again, this is going to happen. We would just enter the amount of contributions to the IRA, and we'll give you some more information there on E15 of your 4012. Again, not a whole lot that we typically see within VITA, but I do want to go ahead and just make mention that it is still a possibility, still within scope. The next thing I want to just cover is student loan interest deduction. So this is a opportunity for individuals who are paying student debt. I'll give you some parameters of what that'll look like, and also just give you a little bit more eligibility rules. We may not have seen a couple of these in the past few years as we've gone through some temporary loan periods where we have not been required to pay interest for many borrowers. Those are starting to lift, so we may see some more interest starting to be paid here. Usually we're going to see a Form 1098E, and that is going to be reporting the amount of interest income paid by the taxpayer for the current year. So typically, in order to take a qualified student loan interest deduction, that loan has to be taken out either for the taxpayer, the spouse, or a person who is dependent of the taxpayer or spouse at the time of the loan. Generally, the loan has to be repaid within a reasonable amount of time after it was taken out. Most student loans are going to have a repayment shortly after the loan was either taken out or the student has ceased their educational pursuits. And it has to be taken out for someone who's pursuing at least a half-time at an accredited institution. So an accredited institution is basically an institution that is essentially approved by the Department of Education and would qualify for student loan opportunities. So again, if we're getting a 1098E, we don't have to go through any of the questions. We're now just seeing what the amount of interest paid would have been. So the deduction that we can take is going to be the lower of either the actual amount of interest paid or $2,500, whatever is lower. We don't need to worry about what that amount is. If you have a 1098E, there's actually a deduction section. You just put in the amount of student loan interest paid, and the system will give you the correct amount, either the amount paid or $2,500, whatever is lower. So a couple rules that we want to take a look at here. So taxpayer cannot file married filings separately. So we've talked about that in the very beginning of our session here with session 1. Married filing separately is not a great scenario here for filing purposes. You're not able to go ahead and take advantage of things like student loan interest deduction. The individual also cannot be claimed as a dependent on someone else's return. So if you have a student loan and your parents are still claiming you as a dependent, you may not take the student loan interest deduction. So if you're a dependent, you're not going to be eligible for this deduction. The interesting part, and I want to make sure this is clear, the individual taking the deduction must be legally obligated to repay the loan. So we may have a situation, you have a client coming into VITA and they say, well, I feel bad. My grandchild has a student loan. They're just getting started to work. So I went ahead and made some payments for them. Can I take the interest as a deduction? Well, the answer in short is no. If you are not legally obligated to repay the loan, you are not eligible to take the student loan interest deduction. However, if you made a payment on behalf of someone else who is legally obligated, then they may take that deduction on their return. So again, we just need to make sure that we have that ability to go ahead and have an understanding of whether or not the person was obligated to repay the loan. Generally, the 1098-T is going to come in the primary borrower's name and social security number. If the individual was a guarantor or had an obligation as a cosigner, then we can certainly take it on their return as well. And generally, we're going to be fine with that 1098-T to show how much interest was actually paid for the year. All right. So as I mentioned, we have some really nice things on the deduction side, but now let's take it up to the next level and talk about credits. So credits are really nice because they're not just going to reduce our income dollar for dollar, which is good, but they're going to actually take care of our tax liability dollar for dollar. So we're going to start off and talk about some non-refundable credits. So what a non-refundable credit is effectively a credit that will start eliminating your tax balance due until you get to zero. Once we hit zero, the credit will basically exhaust that tax liability. You'll get no additional benefit from that credit. But if you have things like withholding or estimated taxes, you can certainly get that money back. So we're going to try and apply these credits first. It'll happen automatically within TaxSlayer. No manual calculation needed. We'll go through that process. So the first one I want to talk about, the foreign tax credit, a little bit more information on G8 of your 4012. If a Form 1116 is required, it will populate. In most cases for VITA, it will not. What this credit represents is foreign taxes paid. Generally, where we see these come in are where people may have an investment account that might have a security that is either owned or doing business in a foreign country and may have some foreign taxes paid on that income. So if you have all of your foreign taxes reported on a Form 1099 INT, Form 1099 DIV, or a Schedule K1, and those amounts are less than $300 for anyone other than married filing jointly, or under $600 for married filing jointly, we can go ahead and enter those exactly as you see them on the input screens for income. It'll automatically calculate your foreign tax credit. No additional forms are required, and we can still electronically file that return. So the foreign tax credit, fairly straightforward. We don't see those on a regular basis, but every once in a while we do have a client that might have foreign taxable income coming off their investment accounts. As long as it's shown on the 1099 INT, 1099 DIV, or the Schedule K1, we can prepare the return without that Form 1116. So I want to talk a little bit more about some of these other credits and where those are going to be coming through. And the first one is going to be our credit for child and dependent care. So a couple changes we have. And again, if you're brand new and I see we don't have any changes, you're thinking, well, I didn't know what it was from the first place, so I don't have to learn anything, unlearn anything, which is true. Most of these, I just want to talk about how they're going to be applicable going forward. Right after the pandemic, we had a couple changes in some of these credits. They're now back to their regular level, shall we say. So we're going to lose some of the refundability. We're going to lose some of these higher income amounts that we had before. So this credit is not refundable. It is going to be eligible to offset tax liability. Once it eliminates tax liability, that's it. We can't take any more of that credit. The maximum qualifying expenses are going to be $3,000 for one child and $6,000 for two or more children. So the max credit you're going to have is going to be $6,000 of expenses. And then the credit's going to range from 50% to 20%, depending on your adjusted gross income. Fortunately, within VITA, anyone who comes into the VITA services will be eligible for the child and dependent care credit. Their income's not going to be high enough to be in the phase-out range. That's over $400,000. I do want to just mention that an individual may have dependent care expenses withheld from their pay. They can do that through their employer. If that happens, that will be reported on the W-2 in box 10. So again, as we're entering the W-2 information, just take a look at the form, make sure that we have all that information entered into the TaxSlayer system. If there is an amount sitting in box 10, it's going to remind you need to fill out a Form 2441. That's going to help determine whether or not there's any additional credit available, or did the employee use all the money that they had set aside in a pre-tax basis. So if they didn't use all of it, then we may have to have a little bit of taxable income. But all we're going to do is just enter the information that we're getting off the W-2, enter it exactly as shown, and then we're going to go through the rest of the child and dependent care process. So just want to talk a little bit about what these eligible rules are. And you may have understood that the IRS is going to treat children differently for a variety of of definitions and credits and dependency. So we talked about things like a child for a qualifying child for dependency is effectively anyone under the age of 18 or under age 24 if they're a full-time student. When we talk about child for purposes of the child tax credit, we're looking here, the child care credit, we're looking at children under the age of 13. So the very first one is going to be a child under the age of 13 that's going to be claimed as a dependent on the return. Now, as we talked about dependency rules, if an individual has waived dependency because they're sharing or switching dependency with their former spouse or other parent, and they have a 8332, the custodial parent can still take the credit for child and dependent care. So it's really taking a look at where is the child having their custodial relationship. The custodial parent's going to be the one who's going to be able to claim these child and dependent care credits. So the government believes once a child is a teenager, once they hit the age of 13, they no longer need any kind of supervision. They are okay to raise themselves. They're fine before school, after school, no problem at all. They're okay. We do not have any ability to take a credit for them once they reach the age of 13. But what's unique about this age definition, most of the other ages we talked about are determining, did the child reach that age before the end of the year? So if they turn 18, they're not going to be eligible for obviously the child rules unless they're still in school. If they're under 17, they won't be eligible for the child tax credit. We'll talk about it a little bit. But in this case, even if you turn 13 during the tax year, so even in 2013, let's just say we have an individual turning 13 on November 1st. We can still take all the expenses from January 1 through October 31. That's entirely permissible. So as long as the expenses were incurred before the child turned 13, they are still eligible for the child and dependent care credit. And we'll talk about what some of those costs are. I mean, that's effectively we're looking at having the opportunity to have a care for a child before school or after school. Also includes things like camps. If you send your kid away for a summer camp, that's fine as long as it's a day camp. You cannot have an overnight camp qualify. It has to be a day camp. Doesn't matter what kind of day camp it is. It could be Lego camp. It could be soccer camp. It could be space camp. Any type of camp you send your kids to can qualify. Any cost that you pay for an individual to watch your child while you're working and have earned income can qualify, with the caveat that in order for us to take a child and dependent care credit, we need to have the name, address, and employer identification or social security number of the person providing care. So we may run into a scenario where someone may say, yes, I have child care for my son or daughter. I go to work, so I have someone in the neighborhood watch my child till I can get home. I pay them $200 in cash. Can I take the child and dependent care credit? Well, if we do not have the social security number or EIN for the individual providing care, we cannot take the credit. The government's looking to match up the individual providing care, that they're reporting the income from the child care, and the person who is paying for the care is then eligible for the child independent care credit. So we do need to have that information in order to proceed. So if we don't have social security numbers or EINs, we cannot go ahead and take the credit for the child. Same thing would apply. We have a couple other eligibility areas here. So that could be a dependent of the taxpayer if they're mentally or physically incapable of taking care of themselves and they've lived with the taxpayer for at least half the year. Same thing if a spouse is physically incapable of care, either mentally or physically, and they live with the taxpayer for more than half the year, they are also eligible for this credit as well. So again, we're looking at the whole living with the taxpayer for more than half the year, which is why we get back to that whole custodial parent situation. If they're married filing jointly, both spouses have to have earned income unless the spouse is the one who's incapacitated. And what we mean by incapacitation, incapable of self-care means that there's generally some condition that they're not able to basically dress, feed, or clothe themselves or clean themselves. Um, so those are the criteria we're looking at. Cannot dress themselves, clean themselves, or feed themselves, or if there's a situation where someone needs to be with them to prevent some sort of injury to themselves or others. So if you're paying for care in those scenarios, we do need to have earned income. So it is going to be an opportunity for us to pay for care, but the individual has to have earned income, generally from wages. It could be self-employment. If you're married filing jointly, both parties have to have it, unless the individual is physically or mentally incapable of taking care of themselves. Some exceptions for full-time students, but we generally don't see that within the VITA program. So again, we'll need to have the amount of care. We'll need to know who is providing the care. Again, their identification number, Social Security or EIN. When you complete the 2441, a little bit tricky the first time because there's actually 2 steps to the process. The first step, we need to enter the provider information. Again, name, Social Security or EIN, address, the amount of the payments made. Then we have to go to the second step and identify which dependent is the one who received the care. So once you match those up, those numbers are going to be confirmed. You're pretty much done with the form. There's a couple other questions you may have to just walk through, but generally we don't need to fill much else out. That will allow the credit to automatically calculate. And TaxSlayer does a great job of determining how much is going to be a credit and applying it on the return. Okay, questions at all on child and dependent care credit? Okay. Let's move over to one of the other ones that we have. The good news is some of these credits are fairly automatic in terms of application. And retirement savers credit's generally one of those. So G17 is going to give a little bit more information. But in order to be eligible, we're looking at a taxpayer who's going to be making a contribution to a retirement plan. So one little tricky part, if they're making a contribution to either a traditional or Roth IRA, we may not automatically have that information, particularly the Roth. We have to go ahead and enter that information on our 8880 screen here. Likewise, we'd also have to enter information about a traditional IRA if they qualify for that deduction. However, most times, most clients are going to qualify because you're making elective deferrals to a 401k or 403b plan, or elective deferral to a government 457 or a SEP or a simple. And you may be asking, how do I find out what those are? Well, the good news is that any of those elective deferrals to a employer type plan will be shown on a W-2 in box 12. So those codes are typically going to be a code D for a 401k, code E for a 403b. I'm going to feel like I'm reciting the alphabet here. It's also an F, a G, an H, an S, a double A, a double B, or a double E are all codes that indicate a voluntary contribution has been made to a retirement plan. So a couple rules here again. You cannot be a dependent. You cannot be a full-time student in order to take this retirement savings credit. You have to be born before January 2nd of 2006. So this is a bit unique. Most times we reference the end of the year being December. But again, I should probably Google to find out which person in Congress was born on January 1 and feel that they have been treated unfairly their entire life because they are a New Year's Day baby. And Ed, I know you're from Florida, but up here in Central PA, we have a very traditional meal, pork and sauerkraut on New Year's Day. They're probably upset if they're from this area that their birthday meal's always been some kind of roast pork and sauerkraut. But Congress has given an opportunity. If you were born on New Year's Day, you are eligible to participate in the retirement savings contribution credit a year early because the rules are basically applying if you were born before January 2nd, 2006, you are eligible to participate. So we don't have to ask the dates. That's actually going to be populated by our TaxSlayer program. So the system will generally go ahead and pull the information as needed from our entries. The only caveats we have, again, we have to look and see if we have an IRA or Roth contribution. And secondarily, the individual cannot have taken a distribution from a retirement account for the current year or the prior 2 taxable years. We should have that information if they've been returning to our VITA site, and we can look back and see if in the prior 2 years that they had a distribution. If not, we may just need to ask. but that information would need to be manually entered for the prior 2 years if they did take a distribution. Quick little note, this also applies for voluntary after-tax contributions to a qualified retirement plan. So we do have an opportunity up here in Pennsylvania for educators to contribute to what they call their PEASERS plan. And that is a program that is designed for individuals in public education. Sometimes there'll be an amount listed in box 14. We do need to confirm that that is a voluntary after-tax contribution, which would then allow that amount to be considered part of our 8880 retirement savers contribution credit. And you can actually, in the tax layer program in box 14, select retirement, not in box 12, carry to form 8880 if those contributions are eligible. Okay, so just a couple more credits I want to talk about here on the non-refundable side. Then we get into the really fun stuff of talking about refundable credits. So what we're going to talk about next are energy credits. So these energy credits are extended all the way through December 31 of 2032. So these are going to be around for a little bit. However, not all energy credits are going to be within scope for VITA. So the first part that we have on the 5695, our energy credit form, are not within scope. These are generally the larger type installations of solar panels, solar hot water heaters, geothermal heat pumps, and wind turbines. These are pretty big improvements to property. These credits can carry over. A lot more rules that we have to worry about. So these are not within scope of VITA. But what is in scope within VITA are our part 2 or non-business energy property. So we now have an annual yearly credit of up to $1,200 for building envelope and residential energy property. And you may wonder what that is. So building envelope components are effectively exterior doors, windows, and insulation materials or systems. These need to be energy certified. So there are certain requirements that these need to meet. So I don't want anyone thinking that, oh, by the way, if I just put a brand new door on my home, it's automatically eligible. It has to meet certain energy efficiency requirements to be considered eligible property. Same thing with residential energy property. These are going to be things like central air conditioning, natural gas, propane, or oil water heaters, natural gas, propane, or oil furnaces and hot water boilers. So we do need to make sure that they are getting certified energy efficient property in order to take that credit. So generally the credit's going to be 30% of the cost, including installation, but up to $600 per component. So you can't put in 4 different things and expect that you're going to get over that $1,200. Is going to be capped at $1,200, and only $600 can come from each of those components. In addition, there's another area too. If you have $2,000 available for heat pumps and biomass stoves, again, it has to be done on the taxpayer's main home. Hopefully in VITA, we don't have people come in, have multiple properties, but it has to be the taxpayer's main home. There are some additional rules that you can find within the 5695 instructions, and also a little bit more information on the G20. On occasion, we see these, but again, predominantly we need to have the documentation showing that they're going to be energy certified property. That's what's going to be eligible for the 5695. Okay, wanted to slide on over and talk about some education credits. And these are going to be pretty popular for individuals that may have either they're taking college courses, or they may have a dependent taking a college course or pursuing a degree. So we have 2 different types of credits available. The first one being the American Opportunity Credit. The second one being the Lifetime Learning Credit. They start with relatively the same base. I'm going to talk about some commonalities, and then I'll go through and talk a little bit more about how each one's unique. So in essence, we're looking at either the taxpayer, the spouse, or a dependent that is claimed on the return who attended an eligible post-secondary educational institution. Again, much like the student loan interest requirement, it has to be a eligible institution. Again, approved by the Department of Education. In general, we're going to be expecting to see a Form 1098-T from the institution, which is going to provide some very, very important information we need to complete the credit. So if you have a college or university, generally those are going to be fine. If you have someone who decided that they would like to go ahead and pursue a opportunity to head out to California and attend kind of a hey dudes school of surfing for a little bit of time, probably not a qualified institution. It has to be a Department of Education approved institution. Has to lead to some sort of degreed program. Okay. Um, okay. So I'm sorry, just saw a question popping up in chat here about the energy credit. Sorry, I'll go back and take care of that real quick. So if you have a new furnace and a new heat pump, is the credit cap to 600, or is there a credit for each? So with those, it's going to be $600 per item. So you can get up to the $1,200 per year as long as each individual piece is up to $600. So you are eligible to take multiple pieces within that $600 per item cap and a $1,200 overall cap per year. So sorry for that quick derivation. Hopefully that helped answer the question. So in order to take this credit, again, it's going to be someone going for a post-secondary education, cannot be claimed as a dependent on someone else's return. So the student themselves cannot take the credit if they're going to be claimed as a dependent on their parents' return. So typically, a parent's going to continue to claim the student if, again, for eligibility rules, they're under the age of 24, they're a student at least on a full-time basis at an institution, and the student does not provide more than half their support. In general, the parents are probably going to get more of a benefit for claiming the child. They're going to be eligible for the education credit. Again, pretty much outside the scope of IDA, but if a parent is not going to get the benefit for the student and they choose not to claim, then the student may be able to claim the credit as long as you're going to get some benefit. Main thing I want to point out, though, is you cannot file return as married filing separately. You're going to hear this multiple times. And hopefully now you're going to see why I cautioned strongly in the first session. Married filing separately is not a great filing status. You're going to be losing a lot of benefits. So we don't encourage people to file married filing separately unless that is their absolute desire and they're understanding what they're going to be giving up here. So cannot file separately, has to be for the taxpayer, the spouse, or their dependent children, or anyone that can claim on the return. So the eligible rules for both of these are going to be tuition. So obviously tuition costs are going to be part of that education credit, plus any required fees or charges, expenses for enrollment. So that can be things like a lab fee or a tech fee or an institutional fee. Those are going to be part of the cost of the eligible expenses here. What doesn't count are going to be things like our room and board expenses. So paying for a room, paying for a meal plan doesn't count. Any personal living expenses or family expenses don't count. So if you go ahead and you come in and say, well, we had to basically buy a bunch of college sweatshirts because everyone on campus is only wearing sweatshirts and college t-shirts. That's great. Way to support the school. Not eligible for qualifying expenses for the education credit. So do not count any of those. It's really going to be your tuition and fees that we're going to be looking at here. So we want to talk about when these payments are actually made. So what's unique is that typically we're going to see one of these credits be eligible for only 4 years. We're going to talk about that American Opportunity Credit. So that's 4 calendar years. But in most cases, students will actually be in school straddling 5 calendar years, not 4. Because if they enroll in a fall semester program, they're going to start in the fall, finish in the spring. And if they do that for 4 years, that's going to actually be 5 calendar years. But what we take a look at for determining when we can take these expenses on the return, right now, colleges are most likely getting ready to either send out bills or have sent out bills for the spring 2024 semester. If the payment's made in 2023, and the student's going to be starting that program within the first 3 months of 2024, those expenses still count for 2023. So what we're basically doing is we're going to pay for 4 years of education, even though the student's probably going to be there for 5 calendar years, but those payments are going to be made in 4 calendar years. So it's actually going to align pretty nicely here for our next credit.
Jared, we had a question on
yep, I'm sorry. Yep.
Parking passes. Are those eligible expenses?
I don't believe the parking pass is, because that's more of a commuting cost. It may be so unless they're required to drive to school and have to pay to park, generally no. So that's kind of considered more of the personal living. It's more so for these, it's going to be directly related to tuition and related costs for education purposes. So yeah, just want to take a look at those. Typically not required for attendance at the institution. But I do want to kind of go through a little bit of what the differences are. So the first one, as I mentioned, American Opportunity Credit, the most powerful of the two. This one, you only need $4,000 of eligible costs. And not quite sure if you've priced educational costs recently at accredited institutions. 4,000 is not a whole lot. It is a relatively low threshold to get over, particularly because with this credit, you need to be at least 50% of a full-time workload. And we're going to determine that 50% of full-time workload because the Form 1098-T that we would very much like getting from the institution will have a checkbox to indicate that that student is at least a half-time student for the normal workload. So again, permitted for the first 4 years of post-secondary education. So if you had 1 year completed, you took a couple years off as a gap, and you go back, we have 3 years eligible left. So what we're taking a look at, the American Opportunity Credit, only $4,000, predominantly tuition and fees, but we can also include any other related course materials, so books, any supplies, any equipment needed for a course of study. So if you have to buy a particular item in your field of study, that is an eligible expense. Good news about the American Opportunity Credit, not only are we getting a $2,500 credit based on $4,000 of costs, but also up to 40% of that can be refundable. So out of that $2,500 credit, $1,500 will be non-refundable, and up to $1,000 is going to be refundable. So even if we completely eliminated your tax liability, you can still get up to $1,000 back based on this credit. So sounds incredible. It is a very, very powerful tax credit. So generally, all the information we need for this will be coming off the 1098-T. Important that we get that form because, again, we need the employer identification number of the institution. We need to know the institution's name and address. We're basically going to fill that out in order to take the credit. So the taxpayer hopefully has one with them, or most often can look that up within their account and be able to take advantage of it that way. One interesting question we have to ask when it comes to the American Opportunity Credit. Probably one of the most bizarre questions we have to ask during the VITA process if people are trying to take the education credit. So as you go through entering the information and you go through the checklist, it's going to come up with a question to say, did the individual or has the individual been convicted of a felony drug conviction? So do they have a felony drug conviction? So again, not quite sure what happened in Congress when they were setting these rules, but someone had raised an objection to say, absolutely, we do not want this credit to go to everyone. Felony drug convicts cannot take advantage. Every other felon can. So it doesn't matter if you have another felony, grand theft auto, racketeering, anything else is fine. Any of those other felonies, you're okay. You can still go to college and get a credit. But a felony drug conviction, so means you actually had been convicted. It's a felony. It's not a misdemeanor. Hopefully your client's not going through and bringing their record and saying, can you help me identify which ones are felonies or not? They should know whether or not they have a felony drug conviction. But if they have a felony drug conviction, they may not take the American Opportunity Credit. So one downside. However, all's not lost, because in addition to the American Opportunity Credit, we also have this lifetime learning credit. And lifetime learning credit is going to be a very, very good credit as well. Not as great as what the American Opportunity is, but it can qualify if you do not meet the eligibility for American Opportunity. And that could be maybe you did have a felony drug conviction. Maybe you've already used your first 4 years of academic eligibility. If you're in college and you love it so much, you decided the 8th and 9th year are going to be really, really amazing in college. I can still go ahead and take a credit. So you can take that if you've already gone through the first 4. You do not need a half-time enrollment. You can actually take this if you're just taking a one-off course at a college. It doesn't necessarily have to lead to you getting a degree conferred, as long as it's an eligible institution. So what the lifetime learning is, it's only going to be your course-related materials, books, supplies, and everything else, if they're bought from the institution. So with the American Opportunity Credit, you can buy your books anywhere. You can buy them at a local bookstore. You can buy them off a national retailer's website. You can buy your books anywhere, and they still qualify for educational expenses. For a lifetime learning, you have to buy those materials through the college bookstore or through the institution. So we can actually add in tuition and fees and related expenses, but we have to take a look at the books and everything else coming through the institution themselves. So the good news is, again, anyone's eligible for the lifetime learning, has no bearing on the amount of years. You can have any conviction you like, still be eligible for this credit. So a very nice one. This is not going to be refundable. It's based on 20% of every dollar you have up to $10,000 of total cost. Okay, how are we doing so far on the education credits? Okay, other than the hopefully the parking pass is not an onerous charge, but unfortunately considered personal. Okay, so let's take a look at this is kind of a, if I want to call Goldilocks or not. We have some very good things like our deductions. We have some really nice things called our non-refundable credits. And now we're heading into our amazing parts, and that's going to be our refundable credits. So I'm going to talk a little bit about two main ones we have here, the child tax credit and credit for other dependents. Also talk about the earned income credit, which is really one of the great parts about VITA. And then I also just want to mention about estimated tax payments. So on occasion, we may have taxpayers coming into VITA who know they owe money and they may be paying taxes in advance. That's entirely permissible, still within the scope of VITA. If they are coming in, they're going to let you know that they made estimated payments. We can enter those in directly in TaxSlayer. Some more information on estimated payments on H7 about where they're going to be entered into the return. But just want to talk a little bit about our child tax credit, and then we're also going to go ahead and talk about the credit for other dependents. So G4 is going to have this information. As we're seeing here, we have a lot of different definitions for child under the Internal Revenue Code. So we had taken a look at the dependency rules for a child, and that was basically anyone under the age of 18, as long as they had the relationship and support test. They can also be a full-time student under the age of 24. But just because you're a qualifying child for dependency purposes does not mean they're a qualifying child for child tax purposes. If the individual's under the age of 17, so we're looking at 16 or younger, by the end of the year, they can get a $2,000 child credit. This is automatically going to be applied as we enter the basic information in a TaxSlayer. We're going to enter the dependents, enter their dates of birth, and this will determine whether or not that they're going to get their child tax credit. So just a couple other rules we have here. Again, they have to be under the age of 17 at the end of the year. That child has to be a U.S. citizen, U.S. National, or resident alien. They do have to be claimed on the return as a taxpayer dependent. So it doesn't matter if they're the custodial parent. If you're claiming them on the return as a dependent, that's what's going to allow that child tax credit. So it's going to follow whoever is claiming the child as a dependent on the return. The child must have a valid Social Security number by the due date of the return. So may come into play if you have an individual who had a child right near the end of the year. We can't file the return and take the child tax credit until they get their Social Security number, or may be happening in case of adoption. We need to have that valid Social Security number as well. So another thing that we have here is the traditional child tax credit, not refundable, but we do actually have an additional child tax credit. This is refundable. Again, this will automatically be applied by TaxSlayer. We do not need to do anything special to get there. But what we're going to take a look at is if the taxpayer has more than $2,500 of earned income, it's going to go through a calculation and allow part of that child tax credit to potentially be refundable. It can also apply if a taxpayer has 3 or more qualifying children. Will also generate that additional child tax credit. Again, not much we need to take a look at. That's going to be automatically calculated on the Form 8812. So if you review the return, you'll see that that's where that child tax credit will be populating. But we do have this unique position. I may be claiming a child on my return as a qualifying child, but I'm not going to get the $2,000 credit because they're 17 or older. So do we lose that benefit? Not really. We actually have another credit called credit for other dependents. And again, more information on G7. But this is going to be a $500 credit for anyone you're claiming on the return that's not eligible for the child tax credit. So the $500 can basically be taking a look at individuals who are age 17 or older that you're claiming on the return as a qualifying child. This could be if you're taking an elderly parent on the return, you'll get a $500 credit because you're taking that dependency role. So system will automatically calculate this again. So it's going to determine if that dependent's eligible for the child tax credit or the credit for other dependents. Again, the dependent has to be a U.S. citizen, U.S. national, U.S. resident. So in this case, residents in Mexico and Canada do not qualify. They have to be a resident of the U.S., not a resident of a foreign country. And again, in this case, you have to have a identification number. Social security number is Kim mentioned earlier, the ITIN, the individual tax identification number, or adoption tax identification number by the due date of the return. Okay, how are we feeling on these credits? Just want to check in and see before we move into earned income credit. The exciting one, the area that we're going to really get all excited about. I'll probably need to rehydrate here a little bit because we're gonna really fly through it. But looks like we may have a question popping up in chat here. So if a question coming in, if the child has an ITIN, are they eligible for the child tax credit? And the answer, unfortunately, is no. So the child must have a valid social security number in order to be eligible for the child tax credit. So as long as it's by the due date of the return, if they're in the process of getting a social security number, it may actually be beneficial to potentially extend the return in order to push the due date from April 15 to October 15 so they can have a valid social security number when that return is filed. But for child tax credit and also for earned income credit purposes, they need a valid social security number. Okay. Any other questions on tax credits for children or other dependents? All right, everyone, getting all excited. You're buckled in, ready to go here. Feel like I'm a ride operator here. We're going to be talking about earned income credit. This is quite honestly the most exciting part about tax preparation here at VITA is having the opportunity to help generate refunds for individuals who truly need it. This is a opportunity for us to give back to the community. We're going to be working with people who are eligible for benefit programs through the Internal Revenue Service, who, if they were preparing the return on their own, would have a tremendously difficult time getting through this information. I could not imagine doing returns by hand and trying to take the earned income credit. The great news is we're going to give you all the tools that you need to know to help a client using our Tax Slayer software. The majority of this is all going to be done automatically. We just need to be sure we get the information in. A couple things I like about earned income credit. It is a refundable credit. It is potentially a very powerful credit. I also like the fact that it is named appropriately. It is an earned income credit. So the first criteria for the earned income credit is we need earned income. And earned income comes predominantly from wages. So the W-2s that we just entered, that we talked about last time, can also come from self-employment income, as we talked about that Schedule C activity, can generate earned income. Also, a third one that we'll be talking about is taxable long-term disability benefits received by an employee prior to minimum retirement age. We don't often see that, but that could be a situation where we have a 1099-R with a code 3. So they might be getting some disability benefits and it can be reported in a variety of ways, but that could give us rise to earned income. So a couple caveats. You cannot have investment income greater than $11,000. Good news, we really don't have many people in VITA coming in with a substantial investment portfolio and trying to qualify for the earned income credit. This is essentially designed for working individuals with relatively lower incomes. So usually the 11,000, I don't think has been a problem at VITA so far. Even though interest rates have gone up quite a bit in the past few years, that's That's a lot of money in a bank account. That's a pretty substantial money market account there for 11,000 of investment income. In case we haven't emphasized this enough, filing status cannot be married filing separately. So that is not eligible for the earned income credit. And as we kind of mentioned, the taxpayer and spouse have to have social security numbers by the filing date of the return. For children that you want to be considered qualifying, they have to have a social security number as well. So if you have a child that does not have a social security number, if they have an ITIN, does that prevent you from filing? Absolutely not. But that child will not be considered a qualifying child for purposes of the earned income credit unless they have a social security number. So what we're basically looking at, the child has to be living with you in the U.S. for more than half the year. You have to be a U.S. citizen or resident alien all year. And we're going to talk about an age test here coming in for eligible taxpayers. So the qualifying child rule is pretty much the same as what we have for dependency. Again, we don't have to worry about the support test, really, probably not much of an issue here at VITA. And they do have to live with you for more than half the year. So have to be in the U.S. for more than half the year, and take a look at a couple other little activities here. So I'll bring the age test back in just a minute here, but just wanted to mention there are a couple other ways in which we may have some non-taxable income show up in a way that we can actually treat that as income eligible for earned income possibilities. One of which will be our combat pay. And I'll talk about that in our fourth session when we talk about military income. But another one could be Medicare waiver payments. So in Pennsylvania and in all other states, generally we have the ability for taxpayers to actually get paid for providing non-medical care to eligible individuals. So quite often, and I've seen it usually, that you might have a relative who's getting paid to help take care of someone who is ineligible for care or ineligible to take care of themselves. So Medicare is going to have a payment program where they're going to have a individual provide non-medical care to that individual and issue a W-2. That W-2 is going to be exempt from federal income, so it's not going to be taxable. But you can go ahead and treat the income for Medicare waiver payments as eligible for earned income credit. So under box 13, there's actually a little drop down here that you can enter the amount that's going to be Medicare waiver payment. And that'll be treated for earned income credit purposes. So you just have to go ahead and do that. If you have any questions with that, D12 has a very good example of how that works. There's also an IRS notice, 2014-7, if you need more information about the Medicare waiver payments. But where does earned income come in? How's the earned income credit work? So the first criteria we have, if you don't have any qualifying children, we also have an age test. So you have to be at least 25, but under 65 as of December 31st. So if you don't have a qualifying child, you have to meet between 25 and 65. Your earned income, the max you can earn before you're phased out of the credit completely, is $17,640 if you're single, head of household, or qualifying surviving spouse. Maximum credit with no children is $600. Now, that is going to be based on kind of a bell curve, if you will. So in order to get the maximum amount, there's kind of a general sweet spot you have that the IRS has a calculation. So when you have just a little bit of earned income, you don't get the full credit. When you earn too much income, you don't get the full credit. It's somewhere close to the middle that'll give you that opportunity to maximize your credit. So if we have no qualifying children, still nice, still a $600 fully refundable credit. But what happens when we start adding children in to the calculation? Once we get to one qualifying child, and again, someone who's lived with you for at least half the year, so we're looking at a custodial parent, looking at someone who otherwise taking that child on the return as a dependent, your earned income eligibility goes all the way up to $46,560 and a maximum credit of almost $4,000 for earned income credit purposes. If you add another child there, we bump up your eligible earned income to almost $54,000. Once you're over 53,918, you get zero. So you kind of go up have a maximum start coming back down until it falls off. Maximum credit of over $6,600. And once you get to that third child, that's all you need. Doesn't matter. 3 is kind of our magic number. You're up to over $56,000 of earned income that you can earn and still be eligible for the credit, and up to $7,430 of opportunity for maximum credit. Great news is those are some excellent numbers. If you're married filing jointly, we're going to have the same credits. We just bump up that income a little bit. So as you can see, for 3 or more children, we're up over $63,000 of earned income, which is almost at the cap of what we can take for our VITA clients. So a lot of people are going to be eligible for this credit. Again, the majority of this is going to be coming through as a automatic calculation. Once we enter the earned income, we enter the appropriate dependents. This will automatically calculate. I often refer to this one as the hugging credit, because sometimes you may have a client coming into VITA, and especially first-time people that may not have known that they're eligible for the earned income credit. So I recommend, if you do not like a whole lot of physical contact, maybe put a thank you, but please don't hug me sign at your desk, because when you see individuals getting their earned income credit, and you can take a look at someone who is making some married filing jointly couple, let's just say $50,000 a year, and they're going to be getting a couple $1,000s back, fully refundable. What that money can do to help them out in their situation is incredibly powerful. So just a really, really touching moment. Again, if you don't like physical contact, please don't hug me sign. Yeah. Cookies are appreciated or something.
Quick question.
Yes, Ed. Yeah.
On that asterisk you have there, it says taxpayer between 25 and 65. If it's a spouse, if either the spouse or taxpayer are outside of that range, does that preclude both of them, or is it only the one that's outside that range?
Yeah, that's a great question, Ed. I would have to quick double check that within the materials, but I believe as long as one of them is there, they're still okay. So that would not preclude necessarily for if say you have someone who's 63 and they're still working, but their spouse is 68. I don't believe that kicks them out entirely for that process. I can double check that, but that's my presumption of how that works. Yeah. But great question. Okay. How are we feeling about the earned income credit? Any thoughts, any questions, any concerns? Anyone have any great stories? Anyone hugged too much? Okay. I have been hugged already. I mean, I will say that. I don't with my tax season, I get a little bit tied up in a couple other things, but I have volunteered at sites in the past, and I have gotten hugs. It's kind of nice. It's kind of a nice time to volunteer. But if you don't want that physical contact, that's fine too. We can certainly have a barrier. I think a couple people I know probably don't want a whole lot of random people coming up and hugging them, but it's fun. It's a great opportunity.
Aaron,
We typically get at
Yeah,
our
okay.
site. We typically get the hugs at the beginning, and near the end is where the people come with what they owe. So it's usually not hugs at the end.
Okay. All right. Yeah. So yeah, definitely. Hopefully we can make sure we're getting hugs in both locations. That's always good. And we'll talk a little bit about how maybe we can help out with the owing part of how we can come up with a couple things. I know that we'll end up kind of shifting gears here a little bit. Obviously, the earned income credit is very, very beneficial. I'm going to go on the other side here in a little bit and talk about some things that might end up owing, and some scenarios we worked out to help them mitigate some of those owing capacity. But
Jared, this
Yes.
is Annette. I looked
Annette.
at the 4012, and I looked up the earned income credit without a qualifying child. And the one question to ask is, were you or your spouse, if filing jointly, at least 25, but under the age of 65?
Right.
So I would assume that since a or was used, as
Correct.
long as one falls in that category, they
Yep.
would qualify.
Yeah, absolutely, Annette. I greatly appreciate you confirming that. That was my initial impression, and I believe we looked at it again. I just did not have the the site in front of me here to verify that. But yeah, so it is, as long as one of them meets it, you're okay. But one has to meet, so they can't be both over 65 or under 25 without a qualifying child. But as long as one's in that range, then they're still eligible. So I appreciate that, Annette. I will make you my official research assistant here, and I appreciate the confirm.
Okay, does that pay, that research assistant position?
Yeah, you get the same pay that I do here. So yeah, well,
Okay, thank
yeah,
you.
yeah, absolutely. All right, thanks, Annette. Okay. So moving out of something we're going to see probably a lot of during VITA, particularly if you're going to be working in a site that has working individuals, we'll see a lot of that earned income credit. I'm going to show you something now you may only see with my demonstration, and that's going to be itemized deductions. So itemized deductions are an opportunity for us to get back to the deduction category. And these are going to be applicable if a taxpayer has some significant deductions allowable by the Internal Revenue Service under the Internal Revenue Code. So F3 is going to go through a couple of those. The reason why we don't see a whole lot of itemized deductions is because in the rise of a standard deduction, in our very beginning session, we talked about who has to file a return, and we use some very big numbers to say if you're single or we're basically around a $14,000 standard deduction. If you're married filing jointly, it's close to $28,000. We have to get over those numbers in order to have a benefit of a itemized deduction. So across the entire population of people filing individual income tax returns, the latest report I'm seeing is we're less than 3% of all taxpayers who are itemizing deductions. And we're talking about the entire spectrum, people that are completely not eligible for VITA preparation. Not many people are filing as itemized deductions anymore. So probably even less so within VITA, but I do want to go over just a couple of these things just so you're aware of what the itemized deductions look like. So these are very specific targeted opportunities that we have within a deductible system. And I'll talk about medical and dental expenses in a little bit more detail on the next slide. But I do want to mention that you have to get over 7.5% of your adjusted gross income in order to get $1 of deduction. So if your adjusted gross income is $50,000, 7.5%, you're looking at $3,750 are your target. You have to get over that amount. If you have $3,751 of eligible medical expenses, your deduction so far is $1. It's going to be anything over 7.5%. So not a whole lot we're going to see on medical. I will give you some examples of how that could come into play. Where we typically see those are significant medical costs. Another category are basically homeowners. So homeowners are going to have a couple different items that are going to be eligible. Typically your home mortgage interest deduction. That's going to be coming off a Form 1098 from the institution. So if you have a loan you've taken out to construct, buy, renovate, basically acquire a property as a personal residence, you can take that mortgage interest as an itemized deduction. Mortgage insurance premiums, they're not back in currently. We don't know if we'll have an extender that'll put those back in, so don't really worry about those at this point. But real estate taxes, if you're paying real estate taxes, those are going to be also an itemized deduction. State and local taxes, for people in Florida, don't worry about this one because you don't have it. If anyone's looking to help volunteer with Ed, you don't even have to come next time because there's no state and local for Florida you need to worry about. But those are typically going to be coming off your W-2s. So if you have state and local income taxes, typically VITA will pick those up through TaxSlayer. Gifts to charity can count. Now, I do want to kind of, again, mention charitable gifts need to be made directly to the charity. So contributions to a charitable organization are going to count as a opportunity for itemized deduction. If you're at the grocery store and they're asking, would you like to round up your purchase so 12 cents will go to a local food bank, that's not a charitable contribution. So it's not going directly to the charity. And again, you don't want someone coming in with all these receipts saying, how much did I actually give? If a taxpayer thinks that they have enough, we will ask them to go ahead and provide us a summary of their contributions. Same thing with medical expenses and everything else. We don't necessarily want them coming in and having us do all that work for them. But if they give us the numbers, we do want to remind them that the numbers that they're providing to us are their responsibility. So if the government comes to ask for appropriate documentation or substantiation, the taxpayer has to provide that. We're not coming up with those numbers for them. So again, just you want to remind them of the documentation rules. As we mentioned with the income section, you can actually get to itemized deductions with gambling losses. So gambling winnings are going to be an item of income. Your gambling losses are allowed up to the extent of your winnings. And if they are significant enough, like I've had with some of my clients, you can actually get to an itemized deduction. But again, you have to get over that initial standard deduction threshold, which again is relatively high and rises each year. So just want to mention a little bit more about medical expenses. Again, F8 will have some more opportunities there. These are going to be eligible expenses for the taxpayer, the spouse, and dependents, and also individuals who could have been dependent, but they failed to meet one of the rules. Like maybe the gross income test was too high for a qualifying relative. Maybe they filed a joint return and were not eligible. Perhaps someone else claimed them as a dependent. So a situation where this may occur is you might have a parent of a child, but they're not claiming the child as a dependent. They can still take those medical expenses as eligible deductions. So again, when we take a look at the prevalence of health insurance and a couple other things, we're not seeing a lot of medical expenses themselves getting us into itemized deductions. But one area that we might see is people who are entering retirement or assisted living homes. So the cost of assisted living is not cheap. It is very expensive. So you may have a portion of those costs or all the costs being considered medical costs. Even an individual moving to a retirement community, if there's an element that the home is telling you is for basically pre-planned or prepaid medical costs, we might be able to get a deduction. But medical costs are going to be things like going to the doctor, your copays, dental costs, eyeglasses, prescriptions, any other type of program. There's a great list in Pub 17 on table 21-1. If you are coming up with next Thursday and you're running out of things to do with your guests at Thanksgiving, always fun game if you pull out the Pub 17 is say deductible or not deductible. And there's a whole list of medical expenses in there. And you can go ahead and see who among you can help identify what the government's determined is deductible. So you may say acupuncture. It is deductible as long as it's a medical procedure. So always a fun little icebreaker there if you want to, if you're in between and you see someone trying to fall asleep at the table, maybe break out the Pub 17, try a couple of quick responses. Prescription medication. Generally, we don't have too much of a problem, but I do want to reiterate, it is medicine that must be prescribed by a licensed doctor and purchased legally in the U.S. So if someone says, I have medication I take, can I deduct that? Absolutely, as long as it's prescribed legally and purchased legally in the U.S. So those are entirely appropriate medical expenses. Again, we may not see much. Yeah, I'm sorry. Go ahead, Ed. Yeah.
Yeah, Jared. So I'll ask the question maybe everyone else was thinking. Green states.
Yeah.
Would medical marijuana be considered a
federal? Medical purposes, as long as it's prescribed by a licensed physician, licensed doctor, and purchased legally. So as long as it will have a legal purchase, those could be considered a deductible, usually more on the CBD. So I think we're looking more at the cannabis derived. But typically, if it's recreational use, would not be considered deductible expense. And has to be purchased legally in the U.S. So generally, those are not going to be considered a deductible cost. Even if it is a green state, it's still by federal law not considered legal for sale. CBD is, so that is actually eligible as long as it's a prescription type medication. But typically, cannabis would not fall under that list at this point. And certainly you would want to have receipts for it rather than just here's a guy I buy from on occasion. You can give him a call to find out how much I bought last year. I'm trying to. I know that's going to be a great substantiation practice. But yeah, so little bit of an issue there. So fortunately, we don't see a whole lot of qualified medical costs, but there are always some unique issues that can arise in the medical world. Okay, want to just take a look at just a couple quick other areas, and one where might be kind of going the wrong way here for us. Well, the last two are kind of actually adding tax back to the return. Are going to be some potential elements with the Affordable Care Act. So, want to just kind of mention for individuals that buy insurance, particularly those that don't have the ability to buy it either from a employer or do not have Medicare or Medicaid eligibility, can go through the marketplace. So, usually healthcare.gov is our primary source. Up here in PA, it's called penny.gov. Florida may have something on their own from the Department of Health, but you can go ahead and purchase insurance. If an individual is getting a Form 1095A, we need to have that form in order to complete the return. So a couple other quick points is there for the past couple of years, there's no longer been a shared responsibility payment. So you do not have to have health insurance or a qualified exemption in order to avoid that shared responsibility payment. That's been waived. So we don't have to worry about any shared responsibility payments for a while. But if they are purchasing health insurance through a marketplace, we do need to have that Form 1095A. There's actually a question in TaxSlayer that'll go through and ask, did you have marketplace coverage? And the question's effectively, did you have coverage for the individuals listed on the return? If yes, it's going to have us complete a form, the 8962. We need the 1095A to go ahead and do that. And the reason why we need to complete this is there's a element called a premium tax credit. And the premium tax credit allows the taxpayer and the spouse to, if they're enrolled in one of the marketplace coverages, and their income's between 100% of the federal poverty level and under 400% of the federal poverty level, they can be eligible for a credit to help offset the cost of medical insurance. Now, most times what we're going to see is not waiting until the end of the year to determine if you're eligible, but instead, most of our clients are going to go through what we call the premium tax credit advanced credit payments. So this is going to be listed on H13 of your 4012. We are heading now into enrollment season. So a lot of times you might be seeing ads on TV or radio or other areas where they're reminding people that they might be eligible for coverage and the enrollment period starting soon, and that they should check out their marketplace for appropriate coverage. Oftentimes these ads may say an individual is able to get insurance for $25 a month. The actual point is they're not getting insurance for $25 a month. What they're doing is they might be able to get into an insurance plan that might be costing $500, but they're getting a $475 advance credit, which is going to be applied against their their medical insurance premium. So net out of pocket, they're paying $25, but they're getting an advance credit based on criteria they provided to the marketplace. So they're basically taking a guess at what their income is going to be for the current year. And the marketplace is going to come back and tell them how much of an advance credit they're able to get. What happens in this case is we need to basically reconcile that at the end of the year. And the Form 1095A is going to show how much the individual paid for their cost of insurance and how much they received in advance credit for their insurance. So as long as those numbers are pretty close to what they estimated, we're in good shape. If for some reason their income went down from the amount that they told the marketplace, they might be eligible for an additional credit. In most cases, we're seeing individuals go the other way, that they may have told the marketplace that they have income of a certain amount, but then something happened and they made more income in the year than what they had originally anticipated or what they've told the marketplace. If that's the case, we may have a repayment here, and I'll talk about some options that we have there. But we have to have that Form 1095A. So it generally should be received by the taxpayer by January 31. If they do not have a copy, they can generally go into their account and look it up and be able to provide the form for us to look at. They can also contact the marketplace with an 800 number we have indicated here. They can take a look if there are any errors on that form. They have to have that corrected. The government does get a copy of the Form 1095A. If we attempt to file a return and the government says there's a 1095A, it will be rejected electronically. We cannot file electronically without that information. So we need to have that 1095A in order to file electronically. Some workarounds, I've heard some people submitted the return by paper if the client cannot provide it. Again, I'd probably suggest we try and get that copy of the 1095A if at all possible to make sure we're doing the return complete and accurately the first time. So with that advance payment, again, I mentioned if their income went down from their initial expectation, we can actually get the balance of the credit. But we may have a change in income that's gone the other way. Hopefully, the individuals know if there's a change that they're aware of, they should notify the marketplace and have their credit adjusted appropriately. But not always does that happen. We've had some situations in the past. This is going back a couple of years. I was brought into a situation where a client had been on the marketplace coverage, had taken a cruise in international waters, went to the casino, hoping to pass some time as they're basically at sea, and had won pretty substantially. Well, what that did, gambling went into, as we talked about in our last session, our taxable income. That also gives rise to her income above the level she told the marketplace, which meant she was no longer eligible for the credit they initially gave her. We may have a repayment if their income is gone beyond what they told the marketplace. And particularly, I think, as Ed mentioned, starting off with hugs and ending with tears is a concept where if their income has gone above 400% of the poverty level, in that case, they will have to repay all of the premium credit that they received. And it is very, very daunting. That's a huge tax bill. One of the things I've worked on, and this is going back just a couple of years, I had an individual come in April 15th. We're running the return through TaxSlayer. She said, I don't think it's going to be that difficult this year. Pretty much things are the same, except for one form that I ended up getting a distribution from her deceased husband's retirement plan. All right, we put that information in, and lo and behold, the income's high enough to push her beyond 400% of the federal poverty level. Generated a balance due fairly substantial, $12,000 to $13,000 range on April 15th. So now we're running into problems. When you run into those, hopefully they come in a whole lot earlier in the year because we can put a pause on that and take a look at some options. In this case, we were able to go ahead and use some of the funds she had set aside and actually contribute to an IRA. And by contributing to the IRA, we were able to bring her income down just enough that we were no longer in that over 400% of the federal poverty level, which meant that the entire amount of credit did not need to be repaid. So saved her thousands of dollars. And we went back from hugs to tears to hugs again. Much more enthusiastic hugs once we got rid of a couple $1,000s of tax bill. But there are some options. We can take a look at HSAs if they're eligible. IRAs could be a possibility as well. But these are probably some bad areas that we run into if their income has gone up fairly high. Not to scare off new individuals. Not everyone we see in VITA is on marketplace coverage, and not everyone who has marketplace coverage has substantial increases in income, which cause a problem. But on occasion, we may see that. So again, most likely if they owe a significant amount of dollars, they may not be looking to walk out of there thinking the return is complete and done if we have some options to take a look at some other solutions. So just want to mention about the premium tax credit. And any questions so far on the premium tax credit or the advanced credit piece?
I have one, and I don't know where it lies.
Okay, sure.
But it's folks where they have not all of the folks on the tax return are on the 1095, or if the plan was actually only for a partial year,
right?
Of course, that it was effective halfway through the year.
Yeah. So there are a couple, those can still be worked on within VITA. I did have a situation where I had, this is a little bit different as well, but similarly related. If you have people that get married throughout the year, that becomes a complex issue as well. So they may have been on the marketplace as single coverage, and then they get married, and all of a sudden now they're on with a spouse, and then the income's too high. there are a couple workarounds we have. And so the 4012 will go through a couple special circumstances. 4491 will go through a couple examples as well, Ed. But yeah, there are some unique ones where we have kind of that shared payment issue. So if not all are listed, maybe some of them might be a situation where you may have potentially a taxpayer might have coverage through an employer, but the spouse and children may not. So maybe it's just a spouse and child that are on the marketplace. I have a situation, a client outside of VITA, where he's Medicare eligible, but his wife is not. So she's on marketplace coverage and covers her dependent child. So there are some unique circumstances with those that may take a little bit more effort to go through with the credit reporting. I know
think
up here
it was the actual credit reporting. How do you split the premium credit when you have a couple that got divorced middle of the year and they were on a plan and then now they're separate?
Right.
I think that was the thing that got a little tricky. We ended up referring to someone else, to a pay provider, because the number of forms that you have to do to try to back out what the actual credit ratio for one taxpayer versus the other was just a little daunting.
Yes, there are a couple that are going to get a little complex, and those are exactly those situations, Ed, where we have either a divorce or even a marriage. I tried to run one last year through VITA because they were VITA clients, but it got too complex. So I said, you know what, I will bring this back to my tax software system and basically run it for them. But some of those calculations are a little bit more complex. The marriage and divorce are one that we may not be able to fully complete those. I know at our site we have a couple people that have been through a lot of those scenarios, and I think Kim, a couple of the site coordinators have gone through and they have their techniques down. We try not to teach all of those because we don't want anyone to be scared and not come back in the tax preparation season. But there are a couple ones that we worked with. So there are a couple little techniques within TaxSlayer to get that to work. But as you mentioned, Ed, there are a couple situations that make this almost out of scope for VITA. Usually divorce and marriage or some of those when we're talking about that premium tax credit. So they can be a little tricky at times.
I don't know what happens at your sites, but I've been at have a number of taxpayers that will think that because they don't go and re-register once you register on healthcare.gov, it actually sets you up in perpetuity until you actually cancel that plan.
Right.
So if you just walk away and say, well, I just didn't register this year, you still have a plan. And we'll have a number of folks that don't even realize they still have an HSA plan. An ACA plan. And it's only when we file and it rejects back saying, well, you have a 1095A somewhere, that they uncover that they still have a plan.
Wow.
That's actually quite typical. We'll get more than a dozen of those.
Wow. Yeah, I'm not quite sure how many we've run into those, Kim. I don't know quite a bit. But yeah, I've seen that personally as well, that we've tried to file a return, it gets rejected because there's supposedly a 1095A out there, and no one really knows what that's all about because they weren't on the plan before. But yeah, so something to probably keep in mind if we have one and it's getting rejected, that would be a good reason to contact the marketplace and basically cancel your account at that point if there's no longer a valid ACA plan. Right. Yeah, always good to talk about some of the actual experiences here to find out how we can do best practices. So enjoy having you here on the call, Ed, and making sure we're doing okay. Okay. So just wanted to finish with one other item here, which is the I call it a first-time homebuyer credit, but it's really more so the repayment element. So this got a little confusing for some first-time volunteers this morning. So I'm going to try and make this a little bit better than what I had done earlier today, which is kind of nice, Kim. I get to do kind of my walkthrough the first time and then get the kind of my dress rehearsal and then do the final one here. So in 2008, the government had provided up to a $15,000 credit for individuals buying their first home. So In 2008, if you applied for the credit, you got $15,000 cash in that year, but you had to restart repaying that credit in 2010 over a 15-year period. So what we're looking at here is that we're getting toward the end of that credit repayment. So most times what we're going to see is an individual, if they've been invited before and they've been repaying the credit, it should automatically carry over. If they're a brand new client, we may just want to double check. They're probably going to let you know that they owe a first-time home buyer credit. If you bought a home in 2009, they also had a credit available, but that one did not have to be repaid. So the people in 2009 got really lucky. In 2008, you had to repay it. In 27, or should I say 2007, you got no credit for buying a home. So always interesting to see how the tax rules change over time. But if you had the credit from 2008 and you're on a repayment plan, you should get a letter from the IRS reminding you of your payment. You can also use a website, which is the first-time home buyer lookup tool, or you can call a number and they will tell you if you still owe. The credit repayment is going to be shown on the form 5405. Sorry. You may be able to get out of this if you had a death of the taxpayer, the home was sold, or the home is no longer used as a principal residence. So we don't see these all that often or have any changes. Again, I'm going to be happy in what I have 2 more years of putting this slide up here, and then we're done with it. So I have the countdown's beginning. So we'll be ending on the ACA at some point here instead of this one. But just as a quick mention, it may be applicable, but the taxpayer should know that they've been repaying this thing for about 12 to 13 years now and would have a repayment unless something else has happened. So just want to go through and kind of mention that. But that's pretty much what we wanted to cover this evening in terms of the actual material, and can certainly entertain any additional questions people may have from an income from last week, or even taking a look here at going through and see if you have any questions from our deductions and credits from tonight. Okay. We'll have an open forum now.
I don't see any questions in chat.
Okay. All right. Let me go ahead and stop the share here to give us a full opportunity then. Okay. There we go. So now we can see everyone and hopefully not have confused faces as to what in the world did we just talk about tonight with these deductions and credits. Hopefully going through all right. So hopefully for the first time volunteers, we didn't scare you off yet? Okay. I'm always making sure that Kim's taking a look and making sure at some point when I'm talking, we don't lose at least 8 or 10 people clicking off and say, I think I'm done with the program tonight. But hopefully we're doing okay.
No, you're so entertaining, Jared.
Well, we try and make it as exciting as possible, as best we can for taxes. So we'll see how that goes. But the good news is for a lot of things we talked about tonight, I mean, there are a couple areas we have to go ahead and fill in. But for the majority, the tax program is going to be walking you through the process. Earned income credit, again, incredibly powerful, but most of the information is automatically going to be populating through it. So it's actually pretty nice to be able to work with. There may be a couple questions we need to ask, but for the most part, they're going to be fairly straightforward in terms of what's going to be within scope. So these are always kind of the fun parts of making sure the income's in, determining filing status and dependency. But then I love this chapter or this section, I should say, because we get to go ahead and figure out how we can get some money back for our clients. So always a great part about the United Way program. Okay, so I think we are still scheduled for another hour and 5 minutes. So we can handle any tax questions you have, either you or a friend of yours may have, or, you know, again, if anyone has any great recipes for next week, we're not meeting next Thursday night. That would probably be very dangerous. Talk about taxes after a full Thanksgiving meal. I'm not anticipating most of us be able to make it through that presentation. So we are not going to be meeting next week, but 2 weeks from tonight, we will have our final session for tax law training and go ahead and talk about, we're going to talk about that case, state and local issues, which are not covered in the 4012. We will have some site-specific material and also talk about military training as well. So if you have a question about military returns. And as Kim mentioned, we're also going to have a representative from our local legal services,
Mid-Penn.
MidPenn, talking about some referral opportunities in case we have clients that need legal assistance. So it's a great partnership we have with that organization and a dedicated team of attorneys that can help them out with legal scenarios. So stay tuned for next week. Hope everyone enjoys their Thanksgiving and has a wonderful holiday. We'll see you back again 2 weeks from tonight with our exciting conclusion. All right.
Thank
Have
you.
a great night, a great week, everyone. We'll see you back in a little bit.